Did you know that you may be able to get thousands of dollars back every year just for owning a home? That's exactly what the Mortgage Credit Certificate, better known as an MCC, can do for you. And yet, most first-time homebuyers have never even heard of it. Well, today we're breaking down how MCCs work, how much you could save, and why you should ask about this program before you close on your home. An MCC is a federal tax credit designed specifically for first-time homebuyers. And unlike a regular tax deduction, which just reduces your taxable income, an MCC is a dollar-for-dollar credit that lowers what you actually owe in federal income tax. Even better, you can claim it every year that you live in the home and keep the original mortgage. Now here's where it gets exciting. Most MCC programs let you claim between 10% and 50% of your annual mortgage interest as a tax credit. It's capped at $2,000 per year. So let's say that you pay $8,000 in mortgage interest and you can use 25% as your credit. That's a $2,000 credit directly off your tax bill, not just a write-off. And again, you can claim it year after year. So how much can an MCC save you above and beyond a typical mortgage interest deduction? Check out this example. With an MCC, this homebuyer pays $6,000 in federal taxes. The homeowner with the MCC doesn't get the tax deduction, so their total tax is $6,300. But they use their MCC to reduce their taxes by $2,000 down to $4,300. This gives them a $1,700 savings over the deduction, and that's just in the first year. To be eligible, you generally need to be a first-time homebuyer, which means that you just haven't owned a home in the past 3 years. However, there are exceptions if you're buying in a targeted area. You're going to also need to meet income limits, and this is based on location and household size. There are purchase price limits, and the home must be your primary residence. MCCs are not automatic. You have to apply through a state or local housing agency, and you must do it before closing on your loan. In many cases, MCCs are bundled with other first-time buyer programs like down payment assistance. So if you're already looking into one of those, you should definitely ask about the MCC. And here's why MCCs are such a game changer for first-time buyers. They directly reduce your federal income tax liability. The extra tax credit can increase your qualifying income and help you get approved for a larger loan. And MCCs can be paired with most loan types like FHA, VA, USDA, and conventional. Now there are a few details to remember. You'll need to file an IRS Form 8396 each year to claim the credit. If you sell the home within 9 years, you may be subject to a federal recapture tax. If you refinance, the credit ends unless you apply for a reissued MCC. If you owe little or no tax as it is, an MCC may not really help. And lastly, and most importantly, always consult a licensed tax professional for any matters of tax strategy. After all, we're not tax experts. Mortgage strategy? That's our thing. The Mortgage Credit Certificate may not be flashy, but it can lead to serious tax savings, especially in those early years when every dollar counts. If you're a first-time buyer, this is a benefit that is definitely worth asking about before you close. For more tips on homebuyer programs and saving money on your mortgage, visit mortgageresearch.com. And if you found this video helpful, please give it a like, subscribe, and tap the notification bell so you never miss an update. If you have questions about MCCs or any other loan programs, drop them in the comments. We're here to help. Thanks so much for watching, and here's to smarter homeownership.